We welcome all of you to the session, and today we will try to discuss on questions which came on the past question papers. But before that, I want to just explain you something with regard to the sessions. Next week we will have a physical session on investment and portfolio management, and I expect to discuss everything with regard to the things which we have already discussed and the lessons, questions, problems, or whatever it is. So you will be in a position to clarify anything there, because that's a chance which you are getting, and you need to just make use of that chance and just see how you can revise what you have learned, because that gives you a certain opportunity to sort out your matters. Because when you get the instructions and lecture things through the online media, there are several limitations. So all those limitations you have to clarify or whatever while coming to a physical session where you can face to face, you can do a discussion and you can put forward your issues and all that, and how you can sort out the issues you can discuss. And today I want to just show you the assignment you need to carry out as per the final examinations requirements. And I will explain it. It has already been uploaded to the system. Right. Now you can just look at it. This is some instructions with regard to the assignment. Now I will read it for you, and I just show you what you need to do. Access the Central Bank of Sri Lanka website and download the secondary market trade summary for 15/9/2020. So this can be done through the internet. You can download it, the particular trade summary. Either you can get a photocopy or get a hard copy, or you can just download it to your computer. It is in PDF format. Then the second part of it, identify the yield curve pertaining to those securities and find the maturity dates or coupon rates of T-bonds in the summary. Now in this summary, there are some treasury bonds given, and the details of treasury bonds are given instead of except maturity dates, coupon rates and all not given there. But in order to get it, you need to go through another publication, and we call it DOSL, Debt Securities Available for Investors, dated 2nd September 2020. So that you have to get to find the maturity dates, coupon rates of the bonds, because there's a serial number given, and that you can refer that serial number to get all these details from the other document. And the third one is determine the accrued interest of all the T-bonds in the trade summary, assuming the bonds were purchased on 2nd September 2020. So if you know the coupon payments, coupon rates, maturity dates and all that, it is easy for you to do the accrued interest calculations. So that is about it. But it is a very straightforward type of a thing. You don't need to, but what you have to do is you have to do accrued interest calculations for all the bonds. There are not so many, but you need to do the things for all the bonds.
Sir, up to which date we have to calculate that accrued interest?
No, accrued interest in the sense now it is like, that's why I just gave the date as 2nd September. That was the purchase date, right? So accrued interest is applicable, I mean, in the context of the purchase date. No? Then you can just look at it and see what is the amount of accrued interest to be calculated. That's what I want to just tell you, because now it's like this. No, now this particular accrued interest in comes when a bond is sold, not on the coupon date, some other date. If you do that, the accrued interest will really come into the scene, right? So therefore, what you need to do is you need to see the accrued interest, the applicable accrued interest for which period. So that can be found by looking at the purchase date and the closest coupon payment date. So that is the way you can see the period at which the accrued interest to be calculated, right?
Okay. Okay.
And we go to the second question. There you have select 5 companies, at least from 3 different sectors, quoted in the Colombo Stock Exchange, and find out the following details with regard to these companies. And you need to have 5 companies, but those companies should be from at least from 3 different sectors. So that means you can't select all the companies in one sector. That is what it means, right? Then the first part A is beta values of the selected companies for the quarter ended 30th June 2020 through an appropriate data collection and analysis. Now, this is actually the beta values to be taken not from the stock exchange data. Not on the stock exchange beta values. You have to get the data from the stock exchange, and you need to calculate the beta values. So that is what you need to do. Give a commentary on the calculated beta values versus the market performance of the relevant company shares. Now, this is not a very straightforward type of a thing, but this is a very comprehensive type of a thing. You should prepare a comprehensive report together with all the data sets, analytical schedules, information tables, etc., and do a comparison with beta values available in the CSC website. Now, it's like CSC website also, the beta values are available, but you don't have to, you are not going to take those beta values and put it here, but you have to calculate on your own, right? That is why these answers has to be, there should be a comparison with your calculated data and the website data. Answers for the both questions should be given in a comprehensive form with not less than 3,000 words. Both questions, right? Completed assignment should be submitted to the IBSL on or before 8 November 2020. So this is the closing date. So you have to submit these assignments on or before 8th of November 2020. So I think this is fairly clear. So what you can do is you just take your own interest and then do it and on your own. So that is my request. So if you do that, then you will get the most marks out of the full marks, so that is what you need to do. I emphasize that it should be your own work. We have our own methodologies to see whether what you have done and whether you have done any this type of some fraudulent activities and all, so that we can check. So therefore, be careful and you do your own work. And even when you come for the physical class next week, you can clarify anything with regard to the assignment, right? And today I will try to discuss question papers, past question papers, and it is part of revision program. And what I need to tell you is working out a certain sum would not, uh, would not really assure the full marks. You can get full marks only if you do the proper explanations, proper workings, and step by step logical presentations. Only will give you the, only can assure the full marks. So that is the most important thing you need to remember. Because just working out the sum would not give you the full marks. So therefore, you have to be clear when you work out the problem, when you work out the sum or whatever, you have to have a good understanding. And with the understanding only you need to do it. It's not a mechanical type of a thing where you are going to do. So it's a well articulated type of a thing. Right. Now we will see what how we can just do it, and during the discussion of questions, I will let you know the types of mistakes you normally make and how you can avoid such type of mistakes and get the most out of what you have written. Right. Now here, there's a thing, this is a little older paper, 2014-15. So they are answer 5 questions, including the question number 1, which is compulsory. The question number 1 is a compulsory question. But even though it is compulsory, there's no mentioning of any minimum marks you should get. So therefore, for your safety, what you can do is, at least if you can write the question number 1 in the question paper, then it's really gives a certain indication that we have already tried the question. So therefore, you will not be penalized on that. Right? But you can answer only another 4 questions. That is the issue. So you can't really omit the question number 1. That is why we say answer 5 questions, including the question number 1. Right. Right. We will go one by one, or I don't know. Yes. Yes, we will go one by one. First of all, you just read it. But in the meantime, if you have any any issues which you have already identified, so you can just come up with those issues. Even you can just send me a message and say that these type of things to be explained or whatever. Then I will do that. Otherwise, I will just go through these questions as in the order of the question paper. Right. Now, question number 1. Give your views and relevant explanations regarding the following statements. Number 1. Portfolios of securities contain less unsystematic risk than individual securities. Portfolios of securities contain less unsystematic risk than individual securities. Now, what we need to do is, in this type of question, first of all, what we need to do is, you need to write down your idea. Your idea about the state. Now, idea means you need to say that whether the statement is correct or wrong. That's the first thing you need to do. So then you have to say, this statement is true. So that is what you can do. Or either you can say, this statement is wrong. Then you have to say why it is wrong. That is why, now give your views and relevant explanations regarding the following statements. Now, first part coming under your views, then second part is the relevant explanation. Right, of course. Now, what do you think? Portfolios of securities contain less unsystematic risk than individual securities. Now, what do you mean by unsystematic risk? Now, there are two types of risk, what we call, one type is called systematic risk, the other one is called unsystematic risk. Now, we start with the unsystematic risk. Unsystematic risk is a risk where it can originate in a particular company's doing business. When they do the business, this unsystematic risk can arise. Now, those unsystematic risks arise in the company itself, because it can be a problem in the management system, it can be a problem in the computer system, it can be some business methodology problem. So likewise, there can be several issues which can crop up in a company, within a company, within an organization. Such risk is known as unsystematic or idiosyncratic risk. Now, when you diversify, or when you take a portfolio of assets from different companies, what will happen is these unsystematic risks can be mitigated. In the sense, some of the risk of now, all unsystematic risks are not in a similar way. So there are several types of risk which can be compensated from the profitable things of the other companies. So such risk, if it happens, then what happens is this unsystematic risk can be reduced to a certain extent. So this is the particular concept or particular activity is called the diversification. So through diversification, unsystematic risk can be reduced. So when you add assets one by one to a portfolio, the total portfolio risk coming down. But after adding several assets, even though you add some more assets, the total risk may not come down. So in that particular point, we know that we have already done the diversification part, and unsystematic risk we have reduced to an extent, and that has been reduced, and from that point onwards there's no further reduction of risk. So that particular amount or that particular risk is called the systematic risk. So whatever the diversification you do, systematic risk cannot be reduced, but you can reduce only the unsystematic risk. So therefore, portfolios of securities contain less unsystematic risk, because since it is a portfolio, than individual securities. So that is correct. So therefore, you can say the statement is correct, because the portfolios are constructed with collection of assets, which we call the diversification of assets, individual assets. So through the diversification of individual assets, we can reduce the unsystematic risk. Therefore, the statement is correct. So that is how the answer should be given. Now, if you put all these aspects to the question, the answer, then you will get full 5 marks. Otherwise, if you just write down that this statement is correct, you might get only, say, 2 marks. But if you give the explanation and saying that portfolio of securities contain collection of assets, and when you have a collection of assets, we call it diversification. Through the diversification, we can reduce the unsystematic risk. So if that explanation is there, you will get 5 marks. 5 marks. Is that okay? Is that okay? Right. Now we will go to the second part of the question. That is, that question is also, has some relationship with the first question. Systematic risk can usually be reduced by random diversification. Now, I think giving the answer for the first question, I think you might have to get automatically. You will get the answer for this in that case. What do you say? Systematic risk can usually be reduced by random diversification. Can you do that? If you can just do a chat or whatever, then that's good. I mean, I can just realize that you all are in the discussion, right? So that's a good thing if you are doing that. Yes, of course. Now we yes, of course. Now we can say systematic risk can usually be reduced by random diversification. So therefore, for the first sentence should be the statement is wrong. That is what you have to say. Point blank, you have to say it is wrong. Why? You can't reduce the systematic risk by random diversification, because systematic risk is the risk which cannot be diversified. So that is the answer for that. If you have written these two sentences, you would get 5 marks. Right. Then you go to the third question, third part of it. Securities whose returns are above the equilibrium line of CAPM should be sold, while securities whose returns are below the same line should be purchased. What do you think? Now, this is a good question to be answered. Securities whose returns are above the equilibrium line of CAPM should be sold, while securities whose returns are below the same line should be purchased. Yes. What do you say? Now, it contains, I mean, it carries 10 marks, right? So therefore, it's a little, little composite type of a question. So you have to deal it with the with a diagram also. If you put a diagram, that would give you more marks. So therefore, if you feel that it needs a graph and graphical presentation, so you need to do a graph also here. Yes, what do you say? What do you say about this statement, whether it is correct or wrong? Yes, it is wrong. Why? Now, you can just say it is wrong, but it is not the total answer, so you have to explain why it is not true. But for doing that, you need to do a certain diagram. And in this particular graph, you need to have a horizontal axis as the R, or the equilibrium return. And in the horizontal line, the vertical line should represent R, and the horizontal line, the beta. So then you have a line like this. That is what you call the security market line, you call it. And on this line, you have the equilibrium return. And if you have a particular return which is above this line, now this is the CAPM or capital asset pricing model line. If you have a particular asset here and another asset here, now above the line, you have this, right? Now, what does that mean? It generates a higher return than the equilibrium return. This generates a lower return than the equilibrium return. So what is the indication or what is the implication? Now, what type of stocks give a higher return than the equilibrium return? If a security is undervalued, it can generate a higher return. If it is undervalued. Undervalued means it has a certain fair value, but in the market it has been undervalued. So then there's an opportunity to have an increase in value, and which gives the particular asset a higher return. Alternatively, if you have a overvalued type of an asset and there's no opportunity to further go up in the value, then since that particular change or particular increase is not very high, the return is also not that high, it's low. That is how the things are. So if an asset which can be denoted above the CAPM line or the security market line, that is an undervalued asset, and it really generates a higher return. And if it lies below the line, we call it an overvalued asset, which generates only a lower return. But when you do the investments in the share market, either you have to sell or you should buy. Then the assets which can be denoted above the CAPM are called undervalued assets, and assets which can be denoted below the CAPM can be regarded as overvalued assets. So when we try to purchase, we need to purchase undervalued assets because it will generate a higher return. We have to try our best to get rid of overvalued assets. So that is the strategy for an investor in the share market. Right. Now we will go to the question again. Securities whose returns are above the equilibrium line of CAPM should be sold, while securities whose returns are below the same line should be purchased. But it should be the other way about. Securities whose returns are above the equilibrium line to be purchased, not to be sold, because you have to buy that type of assets and you need to sold. While securities whose returns are below the same line should be purchased, but it is not the case. It should be sold, not purchased. So therefore, this statement is wrong. And you can really draw a diagram like that and just explain the way it can be explained. So, so that's, I think for this particular part of the question, since it carries 10 marks, you need to give a graphical presentation also and do a appropriate explanation. Is that okay? Right. Then you get another question, which is a very familiar type of a thing, where you get several types of questions like this. Now, there you have states of nature. States of nature means the economy can have such natures. It can be a recession state, or it can be a slow growth state, or it can be a normal state, or it can be a boom state. These are the types of states of nature. By here, there are only 4 states of natures being taken into consideration. And the probability of occurrence. Now, you better, if you can add it up and see whether it comes to 1. That is the first check you need to do. I think when you do that, you will find that it comes to 1. 0.2 plus 0.4 is 0.6. 0.6 plus 0.3 is 0.9. 0.9 plus 0.1 is 1. So that check really is good, now positive. So you can really proceed further. Now there are 2 companies. Lux is one company, the other one is Max. Lux and Max being taken into consideration. The annual returns are given in a percentage form. Now what we can do is, now we can really get rid of these percentage marks when you do the calculations. Otherwise it will be a little cumbersome when you have a percentage mark or even decimals or whatever. So what you can do is, you can just forget about this percentage marks when you do the calculations. But when you do the calculation of the covariance of returns between LUX and X, or we can say L and M. So first of all, what we need to do, we need to just prepare a worksheet. The worksheet will give you the proper way of doing it. But in order to do that, you have to calculate the expected value of Lux and expected value of M. After calculating expected value of Lux and expected value of M, you need to reduce from each Lux and Max the expected values, and both to be multiplied together and take the total. That total will give you the, together with the probabilities, and that total will give you the covariance. So therefore, we need to prepare a worksheet. What I feel is, now in a question like this, though it is straightforward, the time taken for this type of question would be a little higher. So therefore, if you have a good practice, or if you have practice, then it is very easy for you to do this. Otherwise, it might take so much of time. So therefore, you practice yourself to work out this type of a problem. Right. So we will just draw, or just construct a certain worksheet where we can just get the values without much of a problem. So just let's have a worksheet. I have put it this way. So now you have these things, point 0.2, point 0.4, point 0.3, point 0.1. So what we need to do next is you have to deduct from each of these things the values 7.2, and you have to get the values, the values, and here also you have to do that. So then you need to have two columns. Now you get the two columns as uh, now you have L as -3, 7, 10, and 20. The one you have -5, 8, 12, and 15. And from L, you have to deduct 7.2. Right, you get 38.952 for the covariance. Thirty-eight point 95. I got it as 38.95 anyway. Uh, Now I have just worked it out. You can just look at the workings there. Uh, Now the workings are there. Covariance is 38.952. Anyway, now yeah, 38.952. That is the covariance. The value is correct. Now that is the first part of it. The second part determine the expected return and the standard deviation of return of a portfolio consists of 50% of lux and 50% of max. So for this, we need to calculate the standard deviation of lux and standard deviation of max. For that calculations, I have done the worksheet. Now just to go into the worksheet again.
Sir,
Yes.
sir, so that question,
Yeah.
that 0.056 should be minus
Uh,
on the second probability.
yeah. Yeah. Wait. Yeah. 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 Correct. Correct. It should be minus. Yes. One
Accordingly,
check.
that covariance should be
Yes. I will. I will check. I think
38.84.
that there was a mistake there. It's okay. And the first one also. 29.56. Now there's a small mistake, so I will. 38.84. Yes, correct. You are correct. Point 289. 0.941, 0.42. Yes. Yeah, of course. The sigma of lux is that is standard deviation is 6.29 or 29, and standard deviation of max is 6.558. That is correct. Then the covariance is 38.84. That is the correct answer. 38.84. So with that, we are in a position to calculate the correlation coefficient. 38.84 divided by 6.29 into 6.558. That comes to 0.942. 0.942 anyway. 38.84 divided by 6.29 into 6.558. That is 0.9412. 9412 or 942. There's a small difference, but that doesn't matter. As far as it comes to 2 decimals accuracy, it's okay. Right. But the second part of the question would be a little different. So, but you need to get all these details to calculate the last part of it. Now, determine the expected return and the standard deviation of return of a portfolio consists of 50% of lux and 50% of max. Now, how are we going to do that? So 50% of max. Oh, anyway, now you have to get the expected return of lux. We have already calculated that. Expected return of lux is 7.2%. Expected return of M is max is 7.3%. So then we are in a position to get the portfolio expected return of portfolio with the 50% of lux and 50% of max. That is 50% into 7.2 plus 50% into 7.3 will be equal to the expected return, that is 7.25. The expected return of the portfolio is 7.25. Now I think that is a normal thing where first of all you get the expected return of lux that we have already calculated, that is 7.2, and expected return of M that we have already calculated, that is 7.3, and when you have 50% of lux and 50% of max, the portfolio comes like that, and 50% into 7.2 plus 50% into 7.3. That comes to 7.2 plus 7.3 divided by 2. That is 7.25. So expected return of the portfolio is 7.25%. That is correct. Then we have to get the standard deviation of the portfolio. Now for that, we need to have standard deviation of lux, standard deviation of max, and correlation coefficient of x and max, and the weights. So I will write down a certain formula to get into the standard deviation of portfolio.
Sir,
Yes.
so based on this question,
Yeah.
without having correlation coefficient,
Yeah.
we can calculate that portfolio at risk
Yeah. Yeah. Yeah.
by
So I
using
have already.
covariance only.
Yeah. Yeah.
By
Just the covariance. Yeah. Covariance is, yeah. That is also correct. We don't need to get this sigma and all that. Just the covariance will give you the answer. But anyway, yeah. Yeah, just
So
covariance will do. Yes, 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 correct.
yes, this is kind time consuming, I
Yeah,
believe.
yeah, yeah, of course, yes, yes, yes. Yes, that is there. I think that's a good idea because now normally this uh, sigma has to be calculated somehow, but with the correlation coefficient, you are in a position to get the covariance and covariance two covariance WL WM. That way you can do. Anyway, that's okay. Covariance is 38.84. Six point three two nine. This is the answer, yes. 6.329 is the answer. Portfolio standard deviation is 6.329. You get the total value as uh, 40 point something. So when you get the square root of that, it comes to 6.329. I think there, if it is 6.82 or something, I don't know. There can be a little deviation. Uh, of course, now when you experience this type of decimal changes or whatever, that is more or less attributable to the approximations. But if it is rather an approximation, something goes wrong, then that has to be checked. Right. No, since even taken time for that, and but I just want to give you the way of doing it. So there's no shortcuts here, but only thing is as it is the uh, what we do is now when the portfolio standard deviation is calculated, you have to have there are two formulas which you can use. One is sigma p squared, that is the portfolio standard deviation squared is equal to W. Now here we are talking about L and M, no? WL squared sigma L squared plus WM squared sigma M squared plus 2 WL WM covariance L. So this is the easiest way. Rather, if you don't have covariance, what we can do is you can just put it in terms of sigma form. There you have W L squared sigma L squared plus WM squared sigma M squared plus 2 WL WM sigma L sigma M, that way, and rho multiplied with rho. So that is another way. But I think it is easy for you to get since you have already calculated the covariance. It should be given in covariance terms, then that could be more easy. Right. Now I think all of you have now observed the way we can do it, and only thing is with certain type of practice to get the familiarity, and you should not try to get that familiarity at the examination. So you do it before the examination and get that familiarity at the time of examination. So then you will be in a position to score well in the examination with the familiarities. So anyway, what I feel is even though this is a time consuming one, but it is straightforward. So therefore, you should not omit this type of questions in the question paper. So you try your best to do it, and since it is straightforward, you need to have some practice and you have to enhance your familiarity. Right. Now we will get to the next question. Anything you need to clarify on that? Any type of issue? If you have any type of issue, you just raise it.
Sir, how many marks given for final answer? That answer?
Only the answer, no. The answer itself will get only about 5 marks. But say now in this question, the questions marks are given in this basis. Say, sorry. Now you just see the. Now I just want to show you the way it can be done. Now say, first part 10 marks, second part also 10 marks. The answer itself would get say only 2 to 3 marks. The final answer, but there are steps up to the final answer. So that means now if you got the final answer wrong, but you have applied the correct principles and up to a certain level you have done correctly, then up to that level you will get the marks.
Okay.
Because if you have a wrong answer, then normally the whole thing will be checked again, and where you have got wrong, till that point you will get the marks. Right, now the third one. The Elephant Walk company has been experiencing rapid growth for the last 5 years. Analysts expect the 30% growth rate in dividends to continue for the next 4 years. After the above normal growth period, then dividends would grow at a more normal rate of 6% thereafter. Elephant Walk company has a current dividend of $260 per share. If the company has a required rate of return of 17%, what is the value of its stock? Now, when you go through this sum, you might find the theory behind this. Now, the theory is dividend growth model. Now, only problem is you are not in a position to apply the one-stage dividend growth model for this. One-stage dividend discount model, we call it. One-stage dividend discount model couldn't be used because the expected growth of the dividends is 30%, whereas the required rate of return is 17%. So when you apply the one-stage model, then you get stock price is equal to D1 divided by K minus G. K is the required rate of return, G is the dividend growth rate. So here the K is 17%, G is 30%. So K minus G would be a minus figure, and you will get a minus figure for the price, and that is not a possible thing. So therefore, we need to go for another methodology to get at the price of this company, stock price of the company. So for that, we need to see the cash flows in the first 4 years. The current dividend would be 2.6 per share. So therefore, the year number 1 dividend would be 2.6 into 1.3. 1.3. So I think you are following what I'm saying. Now, in this particular case, we are not going to apply the one-stage model formula, because that cannot be done here. Because if you apply that formula, you will get a minus price for the stock. Then we need to apply the two-stage model. In the two-stage model, what we do first would be, we need to get the first 4 years. Here it says it is 4 years. First 4 years, the growth will continue at 30%. So the current dividend is $2.6 per share. And in that case, at the end of the first year, you get a dividend of 2.6 into 1.3, that is 30% growth. So the next year, in the second year, you will get 2.6 into 1.3 to the power 2. Likewise, you go up to the 2.6 into 1.3 to the power 4. So that is the 4th year's cash flow. And that cash flow has to be present valued by dividing the values with 1.17. So that will give the cash flows for the first 4 years. Right. Anyway, you just look at it and see what is really happening. Elephant Walk Company. So right. Now you can just see the first 4 years cash flows. And when you work it out, you get that, and you have to add here at the end of the 4th year. Then the one-stage model is applied. There you have the 4th year's dividend that comes to 2.6 into 1.3 to the power 4. That is 7.4258. 7.426 we can say. Into 1.06, because the growth will be only 6% afterwards. Yes, only 6%. And is the dividend amount, and that is D1 divided by K minus D. K is 17%, D is 0.06. And this is the price at the end of the fourth year, and it has to be present value, then so therefore we have to multiply it with 1.17 to the power 4. So this is the answer. Right, correct. The answer is 5182. To the nearest two decimals, 5182 is the answer. Two point 889, 3.21, 3.566, 57, yes, 3.96, then 38.18. Yes. 5182 is the answer, correct? Very good. And you can expect a question of this nature. You can expect. Anything, any questions here? Any problems or whatever? And what I feel is there are some people who can use a formula, but what I feel is using a formula would not sometimes, if you get it wrong, some mismanagement of your memory or whatever, then you might have a wrong formula getting, and you will get a wrong answer from that wrong formula. So that can happen. So therefore, it is more uh, safe to have this type of calculation, and you will see that that calculation would not really give so much of issues, because you know what you are doing. Because what you are doing is you just look at the cash flows and you do the present value calculation for all these cash flows and get the total of present value, and then you assume you are going to sell that stock at the end of the fourth year. So when you do it at the end of the fourth year or in the fourth year, you apply the one stage model where the dividend growth has become only a normal dividend growth, that is 6% only. So then we can apply the one stage discount model, that is D1 divided by K minus D equal to the share price. So that share price we calculated, and that share price also been present value, assuming it as a fourth year cash flow. So that is been done. That is been done. So therefore, right. Now what I feel is these things are not that difficult, but you have to follow a certain clear path for that. Otherwise, it would become a issue. So just look at it. Describe the relationship between one factor arbitrage pricing line and the capital asset pricing model. You may use the standard notations in your explanation. Now, here I just went through these things on a particular day, but I can just revise it again. Now, one factor arbitrage pricing line is normally denoted in this form. TR is equal to lambda 0 plus lambda 1 BP. Right, now I have written here the equation for the arbitrage pricing line with one factor. So you can read it as ER, expected return, is equal to lambda 0 plus lambda 1 BP. BP is the systematic risk. Lambda 1 is the coefficient. Lambda 0 is also a coefficient. Now, first part talks about the comparison of this arbitrage pricing equation with the capital asset pricing model. I will write the capital asset pricing model also in order to check the similarities. Now you just see. You can compare the both equations. Now the left hand side of the equation gives the expected return or equilibrium return. For both equations it is the same. But if you take the right hand side, in the arbitrage pricing equation you get lambda 0. In capital asset pricing model equation you get RF. RF is the risk-free rate. So therefore you can see when you compare the capital asset pricing model with the arbitrage pricing equation, the first coefficient is the risk-free rate, lambda 0 is equal to the risk-free rate. And if you take the other one, lambda 1 is equal to RM minus RF. RM minus RF is the market return minus the risk-free return. So that is we call it market premium. Lambda 1 is the market premium in that case. So if you give that details or if you give that explanation, that is enough for the question. So you say, this is the arbitrage pricing theory equation, general equation for the arbitrage pricing theory with one factor. Now, if I want to have two factors here, what we can do is, you can say AR is equal to lambda 0 plus lambda 1 BP plus lambda 2 BQ or something like that. That is two factor model. Likewise, you can have any factors within this equation in the arbitrage pricing equation. Right. So this is the explanation we give for this. And in this question, the question asked is the comparison of arbitrage pricing theory and the capital asset pricing model equations. Describe the relationship between one factor arbitrage pricing line and the capital asset pricing model. So that is why I did here. I have just given the one factor arbitrage pricing line. That line is reported as ER is equal to lambda 0 plus lambda 1 BP. That I gave in the board, on the board. And capital asset pricing model is explained as ER is equal to RF, that is the risk-free rate, plus RM minus RF into B. B is the beta. So when you compare with the standard notations, you will find that arbitrage pricing line is a representation of capital asset pricing model when it is given in one factor. That is what you need to say. Right, now we will go to the question. Now determine the values for lambda 1 and lambda 0 that are consistent in portfolios of lotus and rose. Now BP values is given. Now what we need to do here is we have to apply these values for the one factor arbitrage pricing equation. One factor arbitrage pricing equation. So our arbitrage pricing equation is ER is equal to lambda 0 plus lambda 1 BP. Now the question is asked, and question is about determining the values for lambda 1 and lambda 0 that are consistent with portfolios of Lotus and Rose. So we have to select the two portfolios in this chart. We have altogether 3 portfolios. Rose is there, Lotus is there, Arali is there. So we just get the 2 portfolios, Rose and Lotus. So what we can do is we can apply the arbitrage pricing line equation and just put the values there, and you can have the lambda 1 and lambda 0 calculated. So I will work it out on the board. Right, just look at the board. Now arbitrage pricing line equation is on the top. That is ER is equal to lambda 0 plus lambda 1 BP. Now we have taken the question papers data here, and we have substituted the data into the question, data into the equation. Now as per the Rose portfolio, Rose, the equilibrium return is 14% and BP is 0.8. So for that, the equation goes like this. 14% is equal to lambda 0 plus lambda 1 0.8. Then for Lotus, 11% is equal to lambda 0 plus lambda 1 0.5. Now in order to find out the equation, we need to find out lambda 0 and lambda 1. So how are we going to find it out? You need to solve these two simultaneous equations to determine the value of lambda 0 and lambda 1. Right? So we can number these two equations as number 1 and number 2. And since there are two unknowns, what are the two unknowns here? Lambda 1 is one unknown, the other one is lambda 0. So in order to find out lambda 1 and lambda 0, we have formulated two equations, and from these two equations we can eliminate lambda 0. How are we going to eliminate lambda 0? we can deduct the equation 2 from equation 1. You can deduct the equation 2 from equation 1. So we can say 1 minus 2. 14% minus 11% is 3%. Lambda 0 minus lambda 0 is 0. It's cancelled off. Then you have 0.8 lambda 1 minus 0.5 lambda 1, that is 0.3 lambda 1. 0.3 lambda 1 is equal to 3%. So therefore, 0.3 is 0.3 is equal to 0.3 lambda 1. So lambda 1 is 0.03 divided by 0.3. So how can we do the calculation here? So you can multiply this with 100, then it comes to 3. Same thing to be done here. So 0.3 into 100 would be 30. So answer is 0.1. 3 over 30, 1 over 10, that is 0.1. Lambda 1 is equal to 0.1. Now we have got the value of lambda 1. And what we can do is, we can substitute that lambda 1 into the equation number 2. Substitute the value of lambda 1 into equation 2. So equation 2 is this. Equation 2 is this. So what we can do is 11% is equal to lambda 0. We have already calculated. We are going to calculate lambda 0 plus lambda 1. We have already calculated, that is 0.1 into 0.5. So 11% is equal to lambda 0 plus 0.1 into 0.5 is 0.05. So 11 is 0.11. Lambda 0 plus 0.05. So therefore lambda 0 is equal to 0.11 minus 0.05. So that is 0.06. So lambda 0 is equal to 0.06. Or in other words, lambda 0 is equal to 6%. 6%. Lambda 0 is equal to 6%. So now we know the equation. Since the lambda 0 is 6% and lambda 1 is 0.1, you can just put the equation as ER is equal to 0.1 plus, 0.06 or 0.06 plus 0.1 Vp. So that is how we can put the equation, since we know the lambda 1 and lambda 0. No, actually now what I am doing here is, I am referring to this question. Now, describe the relationship between one factor arbitrage pricing line and the capital asset pricing model. You may use the standard notations in your explanation. Now, I have just shown you the one factor arbitrage pricing line equation. So that equation is ER is equal to lambda 1 plus lambda 0 plus lambda 1 BP. That is the equation, right? So that equation has a relevance or relationship with the capital asset pricing model. So that's what at the beginning I just shown you the one factor arbitrage pricing line equation and the capital asset pricing model equation. Now those two equations we compare, and after comparison you have to say something, and you say that expected return of the capital asset pricing model is equal to the expected return of arbitrage pricing line model, and lambda 0 is equal to the risk-free rate. So likewise you have to give that relevance. That is what we did in the first part of the question. Now it carries 4 marks. Then what we did was we just apply these values to that equation. Here the ER is given and BP is given. So I just put the equations, put in these values, and rows and lotus I have taken, and then I put the values of those things, and I can show you the way it is been done. Now you just look at this. Right. Now these are the two equations. Now just see, this is the equation that we call this equation the arbitrage price in line equation. ER is equal to lambda 0 plus lambda 1 BP. Now since the question gives the details with regard to the ER and ER and BP, I took the first one as rows. The rows has these values. It says ER of rows is 14% and BP of rows is a 0.8. So that I just put the values 14% is equal to lambda 0 plus lambda 1.8. Then I go into the second one, that is lotus. Lotus has equilibrium return of 11. 11% is equal to lambda 0 plus lambda 1.5. So these are the two equations, and we call those equations number 1 and number 2. That's why I have nominated these two equations as 1 and 2. Now our task is to find out the value of lambda 1 and lambda 0. Now in order to do that, these two equations are called two simultaneous equations. Simultaneous. I think you have heard about these simultaneous equations in your 8th standard or 7th standard for algebra or mathematics. In Sinhala we call it Samagami Samikarana. Simultaneous equations. Now if you have two unknowns, to find out the two unknowns, you need to have two simultaneous equations. If you have three unknowns, you need to have three simultaneous equations. Now here the position is you have two unknowns to be found. Therefore, you need to apply two equations. Now, these two equations are now here. So therefore, we know that we are in a position to calculate the values for these unknowns. Now just look at these two equations and you find that for these both equations you have similar value lambda 0 both, and in order to get rid of that variable, you can deduct equation 2 from equation 1. And what will happen then? Now in this equation you have 14% and here you have 11%. 14% minus 11% is 3%. Then you deduct this, lambda 0 minus lambda 0 is 0, and you have 0.8 lambda 1 minus 0.5 lambda 1, that will give you 0.3 lambda 1. And this 3% is equal to 0.3 lambda 1. 3% is in decimal form, it is 0.03, and it is equal to 0.03 is equal to 0.3 lambda 1. Therefore, lambda 1 is equal to 0.03 divided by 0.3. So what is the bigger part? Bigger part is the denominator. So if you want to get rid of these decimals, what you can do is you can multiply the both parts with 100, both numerator and denominator. When you multiply the numerator with 100, you will get the value 3 into the numerator. The denominator is 0.3. If you multiply it with 100, you will get 30. So 30 comes to the denominator, 3 comes to the numerator. So 3 over 30 is 1 over 10, that is 0.1. So the lambda 1 is 0.1. Now we have the value of lambda 1 as 0.1. And we can substitute the value of this lambda 1 into the equation 2. That is what I have done here. So you just look at the equation 2 that starts with 11% is equal to lambda 0. Lambda 0 we don't know, plus lambda 1 we know. Lambda 1 we have already found now, it is 0.1. 0.1 into 0.5. So 0.1 into 0.5 is 0.05. Now you just look at the solving of that equation. Now lambda 0 is the unknown figure, and what we can do is we can just take the 0.05 to the other side, that will become minus 0.05. Then 11% is equivalent to 0.11. 0.11 minus 0.05 is equal to lambda 0. 0.11 minus 0.05 is 0.06. So then the lambda 0 is equal to 0.06 or 6%. So that is how this sum is worked out. Right. So last part calculation is that, and if you go into the second part of the question, determine the equilibrium return for earlier using the values of lambda 1 and lambda 0. Right. Now, but 15% we don't know whether it is the equilibrium return. So what we can do is we can make use of this one factor model, and then you can have the lambda 0 and lambda 1 as it is. And BP is given. BP is 0.7 for the earlier. And what we can do is equilibrium return is equal to lambda 0 plus lambda 1 BP. So what is lambda 0? We have already calculated this 0.06 plus lambda 1 is 0.1. BP is 0.7. So 0.1 into 0.7 is 0.07. So 0.07 plus 0.06 is 0.13. That is 13%. So earliest equilibrium return is 13%. That is how we can put it. So for the answer, the part C, the answer would be 13%. If it is not clear, I will just go into the explanation again. Right. Now, in the second part, that is part B, we calculated the values for lambda 0 and lambda 1. We got the value of lambda 0 as 6%. Lambda 1 as 0.1. Now 6% also can be given as a decimal, and that would be 0.06. Right. Now, the last part of the question is to find out the equilibrium return for Lotus. Sorry, not Lotus, the other one. What is that? Aralia. So Aralia's equilibrium return we need to find. But we know Aralia's BP. So just look at it. Right. Now determine the equilibrium return for Aralia using the values of lambda 1 and lambda 0. So Aralia, its equilibrium, the 15% is not the equilibrium return, that is expected return. But BP is given, that is 0.7. So we know lambda 1 and lambda 0. So therefore, what we can do is we can just apply the equation, that is ER is equal to lambda 0 plus lambda 1 BP. So lambda 1 is 0.1, lambda 0 is 0.06. So that means ER is equal to 0.06 plus 0.1 into BP. BP is 0.7, so 0.1 into 0.7, that is 0.07. The answer would be 0.06 plus 0.07, that is 0.13, that is 13%. Equilibrium return for earlier would be 13%. So that is the answer. So with that, I will just stop for a break, and I will again start by 3:40. Now the next one. What is the purchase price for a bond that is paying 8% annual coupon rate in semi-annual payments if its YTM is 12% and it has 3 years and 10 months from its purchase date until maturity? Now, when you talk in terms of accrued interest, the matter comes with, now since it is a semi-annual coupon payment one and it has 3 years and 10 months to mature until maturity, that means the purchase date is not a coupon payment date. It is in between two coupon payment dates. So that is why the accrued interest is applicable here. Now, in order to get some idea, you need to have some drawing or some type of a diagram here to show the particular point at which the purchase is made. And when you say that it has 3 years and 10 months from its purchase date until maturity, that means 3 years and 10 months. And what you can say is, for the next coupon date, another 4 months to be passed. So that means you are at a point where the next coupon date will be 4 months from today. And earlier coupon date is 2 months earlier. That is how it goes. So then the accrued interest would be, because that interest really is due, or it is really owned by the person who sold the bond. So we are talking about that interest, that is the accrued interest. But our task here is to value the bond. We need to value the bond. So what we do is, we try to get the value of the bond on the next coupon date. Next coupon date, right? So, and that value can be present valued. That is what we do here. Anyway, I will just draw a line here and just show you how we can do it. Right. You just look at this line. Since the bond has 3 years and 10 months until its maturity, so I have just drawn a line here. You can just see the point of issue. Point of issue, that is 0. And from that point onwards, altogether, it is 4 years. But I have just mentioned the particular cross after 2 months from the point of issue. So that means that is the point of purchase. Is the point of purchase, right? From that point, the next payment date or next coupon payment date is about 4 months away from the point of purchase. Last coupon date is 2 months away. 2 months away in the sense now it has already passed 2 months from the last coupon date. That is the situation. So with that, we should be in a position to calculate the price of this bond. Now, in order to calculate the price, we have to get the cash flows, and we calculate the price for the next coupon date. So next coupon date would be marked as number 1. Next coupon payment date is marked as number 1. Right. So that is that at that point we need to get the bonds price calculated. And here the bond as per the details given in the sum, its coupon rate is 8%, annual coupon rate, and semi-annually paid. YTM is 12, and that those are the other details available. So right, then 12% is the YTM and 8% is the coupon rate. They are not given the bond value, I don't know. So if the bond value is not given, we normally consider it as 1000. Because it doesn't matter, because you can have a particular value as the face value, it is 1000 say. So we assume the face value as 1000. If the face value is 1000, what do you mean by 8% coupon? For 1000 it is, per annum it is 80. But for a half year it would be 40. So 40 would be the coupon payment. So for the next coupon payment dates, you can calculate the cash flows, right? So that way you do the calculation, and there you calculate the price on the next coupon date, price at the next coupon date. So that means after now today we have purchased the bond, and there have to be 4 months gone, should be gone. So after 4 months, the coupon payment date will come. So on that day, the price is now going to be calculated. Right. In order to calculate that price, I will write a certain cash flow equation. Now the cash flow is 40 divided by 1 plus 0.12 the power 1. Then you get 40 divided by 1 plus 0.12 to the power 2. 40 divided by 1 plus 0.12 to the power 3. 40 divided by 1 plus 0.12 to the power 4. Then
Sir,
4 divided by 1 plus 0.12 to the power 5. 40 divided by 1
sir,
plus 0.12 to the power 6. And 1040, because at the last point you got 1040 and is 1.12 to the power 7. So this is how the calculation is
sir.
made. Yes.
So
Yeah.
YTM is given, it is annual, 12%.
Yeah, it's okay, annual. It's
So
okay.
when it come to that semi-annually,
Uh,
when it come to semi-annually,
yeah.
it
Okay.
should be 6.
Okay. It should be 0.06. Right. Now you have this equation, 40 divided by 1.06, then 40 divided by 1.06 to the power 2, 40 divided by 1.06 to the power 3, 40 divided by 1.06 to the power 4, 40 divided by 1.06 to the power 5, 40 divided by 1.06 to the power 6, and 1040. That would be the last payment together with the coupon payment, because it's a 1000 face value bond. So the 1040 would be the last cash flow, and it has to be present value would be 1.06 to the power 7. So if you do the needful, then you will get the value here. We will see what is the value. What is the value you got? 880 something? Yes, 888.23523. Yes, yes, correct. So what we can do is we can just round it off to two decimals, that is 888.35. The nearest two decimals. To the nearest two decimals, you can have it as 888.35. Now, only thing is now still we have not got the answer. But this value actually we calculated the price of the bond on the next coupon payment date. That is 4 months away from today. 4 months away from today. So now we have to get the present value of that on the basis of now this is the value, but there's another thing which we have to add here, because the coupon payment which is coming on the same day, so you have to have it, you have to get it, then you just add 40 here. You can say the value of the bond on next coupon date equal to 888.35 plus 40. Now this 40 comes on this point because it is on that day it comes. So altogether the answer is 928. No, it's 928.35. This is the value of the bond on next coupon date. Next coupon date. So what we can do is we have to get the present value of this bond as at today. So that is the bond value. That is the bond value. So what are we going to do? So today's price of the bond is equal to 928.35 divided by 1 plus 0.06. Now we are talking about a half year, but this is now when half year means 6 months, but there are only 4 months from this point. So that means 4/6 would be the if it is in half year terms, it is 2/3 of a half year term. So therefore you put it as 2/3. So if you calculate this, we will get the value. get the answer as 892.98. Yes, correct. Now, when you calculate this, you have taken into consideration the coupon payment received on the next coupon payment date. Actually, that 40 coupon payment is not entitled to the purchaser, the buyer. Out of that 40, particular part is owned by the seller. So that is what you call the accrued interest. So what is the accrued interest then? So for the whole part, for the whole half year, the applicable coupon interest is 40. But what is the time period the seller kept the bond in this coupon period? So in this coupon period, the seller kept the bond for 2 months. Since it is a 366 year this thing, this 2 months is it is 1/3 of the 6-month period. 1/3 of the 6-month period. So therefore, the entitled accrued interest for the seller would be 40 into 1/3. 40 into 1/3. That is, when you calculate it, you will get 40 divided by 3. 13.33. That would be the accrued interest. Yes. Right. I think this is as a total full question. If you have understood the things, then there's no big issue, and it is straightforward also. But you have to be careful when you do these calculations, and you have to apply those things in a proper way. And I think the drawing would help you. The drawing, putting these numbers and getting the drawing would help you to calculate the things, and you won't get any type of confusion by clearly having this type of a drawing. Anything, any question on this? And actually, when you calculate the bond value here, that bond value is known as the dirty value or dirty price. Dirty price. We call it the dirty price. Yes, anything board is not clear. I don't know. It may be the light, and there are some shining points. No, that is what you are saying. No, there are some shining points also. But anyway, I will just say now what I did here was, I don't know whether this drawing is clear. I have drawn a line starting from 0 and 1, 2, 3, 4, 5, 6, 7, 8. That means there are 8 payment points, and I took the full 4 years for that particular bond because the purchase was made in such a manner that from the purchase date, the maturity date will be 3 years and 10 months away. So that I have just mentioned here. So the first point is taken as the point of issue. Then there's another arrow I have given, that is point of sale, point of purchase. Now from the point of purchase, to the next coupon payment date, 4 months. To the point of purchase from the issue date, 2 months. Now that is clear. Then what we did was we just calculated the price of the bond on next coupon date. Next coupon date. So for that we do the calculations. We did this 40 divided by 1.06. That is the payment on the second date. Then 40 divided by 1.06 to the power 2, that is the third date. 40 divided by 1.06 to the power 3 in the fourth date. 40 divided by 1.06 to the power 4 in the fifth date. 40 divided by 1.06 to the power 5 in the sixth date. 40 divided by 1.06 to the power 6 to the, that is the seventh one. The last one would be 1040 divided by 1.06 to the power 7. Now this 7 comes as half yearly time periods. Half yearly time periods. So with that calculation, you will get 888.35. If it is not clear, so now you can follow, I think. If you do the calculations, you will get that answer, 888.35, but it is not the total answer, but I have just taken it as a I have rounded it to the nearest 2 decimals. So then what we need to do is, that is the value at 1. That is the next coupon payment date. But what happens is, that day onwards, there will be another payment on the basis of the bond. So that is 40. So what we can do is, we just apply that 40. Then altogether, the value would be 928.35. Now that value is for the next coupon payment date, but it has to be present valued as calculated today. So then we need to see how long from today to the next coupon date in terms of half years. So if you put it in terms of normal months, it is 4 months. 4 months is, if you take half year, there are 6 months. So 6 into 6 of over 4, that is 2 over 3. So this is the 2/3 of a half year period. So what we do is, we just do the discounting by having this yield to maturity 1.06 to the power 2/3. So when you do the calculation, you will get the answer as 892.98. Yeah, board is not clear means, but that in order to just do it particular this thing, I just read it again because so we will try to. Now what happens is, now there's a particular shine. So that since that shine comes, the board is not very clear. But anyway, I just gave you the way it can be done. I don't know, this line is clear, the upper line. So we will see. Now I think the most important thing is just this line, because gives you a certain understanding. This is the point of issue. So we can say 1, 2, 3, 4, 5, 6, 7. So this is the place where the purchase is made. Now can you see? But I think the line is now more clear, no? The line. Okay. Now, if you correctly draw the lines and just mark the particular points, then you can get a clear idea about how you can calculate the price of the bond. That is what I want to tell you. Right. Now we will go to the next one. Time period. Yeah, time period actually. Now, I don't know whether you can you see this line? If this is the line. So this is the point of issue. This is the point of issue. No, time period in the question means what? Now our matter comes here is, now in the question it says another 3 months and 10 months to 3 years and 10 months to mature. That is the point we are looking at. That is the purchase point. So I just assumed that the bond was really issued on earlier coupon date. That is from the maturity date, it is 4 years. So I took it as a 4-year bond. So then to that point, a particular seller has got his coupon payment. But he has to get the coupon payment for the next level, but he will not be entitled for the whole coupon payment next time. That is why we just try to see what is the actual or accrued amount of interest for the seller. So the time period is taken for in that manner. Now, the particular point I have marked there, so that is the purchase point. The purchase point is 2 months away from the issue date, and 4 months, another 4 months to be passed up to the next coupon payment date. So that is the thing which you need to understand. So from there onwards, there will be how many half-year periods? There will be how many half-year periods from that point onwards? From the next coupon payment date, there will be 7 half-yearly periods. 7 half-yearly periods. So that means it really consists of 3 years and 6 months. Basically 3 years and 6 months and 7 half-yearly periods. So that is why you get 7 values to be added up. 40 divided by 1.06, 40 divided by 1.06 to the power 2, 40 divided by 1.06 to the power 3, and so forth. It goes up to 1040 divided by 1.06 to the power 7. So that is why we have taken 7 cash flows. 7 cash flows for 7 coupon payment dates. So that is the time period perspective of that. And I just got it as the total, I got it as 888.35. But the matter here is, we have just taken into consideration the future type of things. Whereas on the coupon payment date, we just calculated the future cash flows, but on the coupon payment date, there's a payment of 40. So that 40 also to be added there. And when it is added, it would be 928 and cents 35. Then that has to be present value to today. So that is today is 4 months from the next coupon payment date. And if you take it in terms of a half year, it is 2/3 of a half year. So therefore, you just put it as 2/3, power of 2/3. And when you do the calculation, you will get the real value of the bond. That is the value of the bond price. And this price is normally referred to as dirty price. We call it the dirty price. Okay. Right. And we will see. But I think this is a normal question which you could expect. And in bond calculations, this has a very important aspect, because in most cases, when bonds are purchased, they don't purchase it on a coupon payment day. Therefore, you all should understand how you should calculate the price of a bond when it is not being purchased on a coupon date. Therefore, this is a certain level that we should understand. And if you don't understand this, I think you have some deficiency as an investment advisor or investment analyst. So therefore, you have to be careful and you need to understand it in a proper manner. Right. When you go to the question number yes. I think we have done several questions now. Question number 6. Explain the importance of modified duration as a measure of interest rate sensitivity. Now, the modified duration it's a type of a relationship between the yield and the price of a bond. The importance comes with that. So I think in order to explain that, you have to draw a diagram or draw a graph. I think in my presentation, I have just gave that diagram. Anyway, for the time being, I will just put it on the board. But I don't know if the presentations are there, you will be in a position to just look at it again now. But anyway, to show you that I don't think that it is necessary for me to just do it again. And importance means the modified duration is a certain measure which you can get an idea about the price change of a bond due to the interest rate change. So that is the answer for this. Therefore, the modified duration is a particular factor where we can get an idea about a value change of a bond as a result of the interest rate change in the market. Basically, if you have an interest rate increase in the market, the value of a bond can go down. So therefore, this relationship is an inverse relationship, negative relationship. If the interest rates go down, invariably the value of the bond would go up. The modified duration gives a certain quantification of that value change. That is the importance of modified duration. Right. Now, I think the importance of modified duration is clear enough. Now, rather than going into more theory and all, what you need to understand is the modified duration is a measure of interest rate sensitivity. What do you mean by sensitivity? What is happening to a bond's value or the price with interest rates moving, either upwards or downwards? If the interest rate moves upwards, the value of the bond will go down. If the interest rates move downwards, the value of the bond go upwards. So that is how it behaves. So we can get an idea, or we can get a quantitative idea about this change through the modified duration. So that is the importance of modified duration. Because in portfolio management, we are in a position to make use of this in a very efficient manner. And even a portfolio value changes can be accounted for, can be found. And this is really applicable for all profit and loss calculations in a portfolio. Right. Shall we move into the next section? Now, another thing I want to stress that in most of these modified duration calculations, we have to go by with the assumption that yields are continuously compounded. You know what is meant by continuously compounded. So you are not in a position to calculate 1 plus 0.06 to the power 4, something like that. It is a normal compounding. It is not continuous compounding. It is normal compounding. But here, we all will have to follow the continuously compounded yields. Now the bond details are given. A 5-year bond with a yield of 8% per annum and coupon is 6%. End of each year. End of each year. That end of each year means what? So I think you have to identify whether the coupon payments are done annually or half yearly. So for that, you have to clearly read the things and understand it clearly also. Just by reading this, what do you feel? A 5-year bond with a yield of 8% per annum pays a 6% per annum coupon at the end of each year. So what does that mean? It is not a semi-annually paid bond. Its coupons being paid annually. There's no half-yearly business here, all are annual. So therefore, we just may mean that. And in the case of our duration calculations, we need to have a worksheet where you can say a 5-year bond, and there will be five cash flows. First cash flow at the end of the first year, second cash flow at the end of the second year, third cash flow at the end of the third year, likewise, and it is up to fifth year. So how do you calculate the present value of this cash flow? So what you can do is, the cash flow is, we all know that since it is an annual payment of 6%, so you assume that the bond is 1,000, and 6 means 60 would be the annual payment. So how are we going to get it? Now, at the end of the first year, what is the present value of that 60 cash flow? 60 into e to the power minus 1 into yield to maturity is 0.08. E to the power minus 0.08. And that will give you the cash flow or present value of the cash flow which would be received at the end of the first year. Likewise, you can do the second year's cash flow present valued and third year's cash flow also present valued. That way, up to fifth year, you can have the present values. So that is how you have to apply the worksheet. Is that clear? Okay. We will do you can say time, cash flow, present value, then weight, time into it. Now these are the column headings: time, cash flow, present value, weight, time into it. Now time is this and weight is this. Now when you say time in years, 1, 2, 3, 4, 5. It talks about 5-year bond. And cash flows are, we assume the face value of the bond as 1000. So cash flow is year 60, 60, 60, 60 and 1060. Now when you want to get the PV, it is 60 into e to the power minus 1 into 0.08. And the second year you get 60 into e to the power minus 2 into 0.08. Then the third year, 60 into e to the power minus 3 into 0.08. In the fourth year, 60 into e to the power minus 4 into 0.08. And the last one, 1060 into e to the power minus 5 into 0.08. These are the values, and you have to calculate those values. Now the first year present value 0.08 minus E, that is 0.9231 into 60. The value comes as 55.39. I will say 386 or 387. 55.387. $55.387. The second year, $51.129. 51.129. The third year, 47.198. 47.198. In the fourth year, $43.569. The last year, fifth year, that is 710.539. Now, if you take the total here, I will just get the total. You can just verify whether you have done it correctly. The first year's cash flow, the present value of cash flow is 55.387. Second year's present value would be 51.129. Third year's present value is 47.198. $55.387 plus 51.129 plus 47.198 plus 43.569 plus 710.539. That comes to 907.822. 907.822. Now, when if you want to get the price of the bond, now it is there. It is 907.822. Yes. The total. It's okay. Then we have to get the weights in order to get the duration calculated. You have to get the weights. So first of all, you get the rate for year 1, 55.387 divided by 907.822 equals to 0.0610. So I will put it in 3 decimals for 0.061. We can put it as 0.061. Then the second one, 51.129 divided by 907.822. That is 0.0563. Or I can put it as 0.056. Then the third one, 47.198 divided by 907.822. That is 0.0519. So I will put it as 0.052. Then I go to the next one. There you get 43.569. That has to be divided by 907.822. That comes to 0.0479. So that is 0.048. 0.048. And the last one. And 710.539 divided by 907.822. That is 0.7826, and we can put it as 0.783. Now we will see whether the total comes as 1. If not, we can have, we should do an adjustment. 0.061, 0.061 plus 0.056 plus 0.052 plus 0.048 plus 0.783. It comes as it is, so the total comes as 1. And all figures are correct. Now we need to get the time into weight column. Okay, so there what you do is the time column has to be multiplied with the weight column. 1 into 0.061, that is 0.061. 2 into 0.056, that is 0.112. 3 into 0.052, that is 0.156. Then 4 into 0.048, that is 0.192. 0.192. And the last one, 5 into 0.783, that is 5. $3.915. Now, if you take the total here, the total comes as the duration. We will see what is the total. 0.061 plus 0.112 plus 0.156 plus 0.192 plus 3.915. You get the answer as 4.436. This is the duration. 4.436 is the duration, correct? Yes. And we will again go into the question. Now, duration has to be, now we have already found the duration. And in order to find the convexity, what we should do, we need to have the time squared column. And that time squared column has to be multiplied with the weight column. And the total to be taken, that will be the convexity. So can you just try to see what is the convexity? Just get the convexity calculated. Because if you just involve with these things and you can learn the things properly. The convexity also can be calculated in that manner. Yes. What is the value you got for the convexity? Convexity is, yes, correct. 21.096. That is the convexity. Very good. What else? Right. If the market yield has gone up by 3%, what would be the value change of the bond? Now, just see. Now, they are talking about a very high level market interest change. Because I just told you, if the market interest change is basically higher than 1.5%, then you are not in a position to just do the price change calculation in the simple way. Now you have to get the convexity adjustment also. So for that we need to have a certain now here the answer, now they don't I mean in this particular question it is only you just ask to get the duration is to be taken only here. In that case, I will just show you the way it can be done. So price change, we have to get the price change. Now price change can be taken by multiplying the price with the change of interest rate into duration. So that is the simple price change. But when the yield change is higher, the answer would not be so accurate. Therefore, we have to make an adjustment there. First of all, we calculate the value change of the bond just by applying only the modified duration principle. So we are not going to have the convexity adjusted there. So for that, the value can be calculated this way. The price change is equal to, or in other words, we put it as delta P. It is equal to P into delta Y into minus duration. P into delta Y into minus duration. Right? So that is the answer. So what you need to do is, you need to get the price of the bond, that is 907.822 multiplied with the duration, that is 4.436, and it is to be multiplied with minus, or in other words, you get the answer and it is minus. So that has to be further multiplied with 3%, that is 0.03. So with that you will get the price change. So if you do the calculation, what would be the price change? So you have to get the price change only in terms of the modified duration. 907.822 into 4.436 into 0.03. Yes, price change would be 120.81. That's a big price change. 120.81, that is the price change. Now the calculation has to be done first of all without taking into consideration the convexity adjustment. So without the convexity adjustment, you can take it as minus 120.81. But in order to have the correct price change calculated, you have to put the convexity adjustment also there. What you need to do is half into convexity into delta Y squared into price. That has to be added there. I don't know whether you got my point. I'm referring to the question numbers third part. I don't know whether you have calculated that value change. Now, first of all, you calculate the value change only considering the modified duration. Only considering the duration. You should not consider convexity at this point, and you have to show that convexity also to be taken into consideration because the value, the interest rate change is so much, is 3%. Right. You just look at the formula here. Now, in order to calculate the price change, and it is denoted as delta P, in a simple form, you can have it minus P into duration into delta Y. Now, it's basically simply multiplying the bond value with the duration and with the interest rate change. So that is a simple way of getting the price change. It is correct when the interest rate changes are low, less than 1.5. But here the case is 3% change. But even you can just calculate it and see what is the value. It comes as yes, you got the price 112 because say, yeah. But if you just add it for the only for the without the convexity adjustment, if you do that, then you will have this. But if you want to do the convexity adjustment also, you have to put this plus half into convexity into delta Y squared into P. Now there you get, we got the convexity as 21.096. So half into 0.5 into convexity is 21.096 into delta Y squared, that is 0.03 squared into the price of the bond, that is 907.822. Yeah, you get 8.62618, 8.618, that is plus. Then the price change would be 120.813 minus 8.618. 112.195. Okay. Okay, I think your answers are more or less close. Then the new price would be 795.62 I got. Anyway, there are small changes here, but I think the way you did was okay. Now Nirodhi's new price is taken as 620. Why? How can it be so low? You just look at it again. It should not go so low. 620 means there's a drop of about 380. So there's no such drop. Okay. I think what you can do is you can just do it again and see where you have made the mistake. Right. Now I think the last part is very important for this. If you do not understand the theoretical background here, you are not in a position to answer this question. Comment on the accuracy of your answer and explain any steps you could recommend towards a more accurate answer. So the reason is now, though I think some of you might have gone to the adjustment together with adjustment, you did it. But what you could have done was, you can just do it without the convexity adjustment and say that 3% is a rather substantial increase in the interest rates. Therefore, it is necessary to have this convexity adjustment. So with the convexity adjustment, you get a more accurate figure. And this comment should be given, and you have to say that the modified duration and convexity, the assumption for this is now modified duration. When you calculate the modified duration, the assumptions is that the interest rate change is very, very small. Since interest rate change is small, you assume a straight line type of change in the price. Whereas when you have a 3% change of interest rate, it is not a linear type of a thing. So therefore, you have to go to the convexity adjustment. So with the convexity adjustment, the answer is correct. So therefore, you have to give that comment as the answer for the fourth part of the question. Now you see that all the parts are carrying 4 marks each. So that means if you made a mistake in one part, you lose only 4 marks. Therefore, you need to have a comprehensive idea about these things in order to get 4 marks. Right. Any question on this? So I think today we have done altogether 6 questions. I think that's a good achievement today, because we can't rush these things. To have a proper type of familiarity with these things, you have to just think over the things and do the sum. That is what you need to do. So anything, any question if you which you had in your mind and because of what we have done today, we can answer that questions.
Why we are using the e to the power rather than dividing by 1.08 to the power something like that?
Pardon?
To calculate the percent value.
Yeah, that is. Oh, that's the thing. Now, I think I just really emphasized on that when I did the class for this one, the duration and the convexity calculations. Now, e to the power thing comes with the compounded interest, continuously compounded interest. Continuously compounded is that.
Okay.
Now, if it is not so, what we do is just like 1.06 to the power 2 to the power 3. Likewise, it comes. But here, it is not the case. We did it in continuously compounded interest yields. Now, I just told these things earlier also. Now, what is the meaning of continuously compounding? You compound the interest at any moment. That is what you mean by continuously compounding. Now, there's no time period as such. The time period is less than a second even. It is 100th of a second. This continuously compounding is happening. That is why we have to use this e to the power things for that. Now, in normal financial analysis things, rather than doing this normal compounding, the continuously compounding is the accepted norm in financial analysis practices. That is why we have to go by this. But anyway, some of the things still we are doing under normal compounding basis. But you don't need to be worried. If necessity is there, I will say that compounding, continuously compounding basis has to be followed. So if that is the case, you have to do this in this manner. Otherwise, you can do the other way. And you need to just see how we can deal with this portfolio immunization. I think I did some matters, some type of problems with the portfolio immunization process, right? And I think you get an opportunity now. All of you can just participate in that physical session in the next week, and that day we will be in a position to clarify and sort out the matters what you are going to face. So with that, I just wind off the session today. If you have anything to clarify, just now tell me, or otherwise I can wind off the session now. Thank you very much for your active participation in this. And we will meet on next Sunday, that is 27th of February. So then make sure that you prepare yourself with whatever the issues you may going to face. So then we will discuss those things. Thank you very much.